Alright traders, welcome back to the channel. Today, we're diving deep into one of the most important concepts in trading that separates consistent traders from the rest, which is market structure. When you can read structure mechanically, three things happen. Your win rate improves, your trades become more confident and better managed. You gain total clarity when you open your charts every day. Without further ado, let's get into the video. Understanding basic market structure is essential and forms the foundation of successful trading. In textbook examples, market structure involves identifying trends through clear sequences. Higher highs and higher lows characterize a bullish trend, whereas lower highs and lower lows mark a bearish trend. This simple definition provides traders with a clear, structured way to recognize market direction. However, when analyzing real-life charts, market structure becomes slightly more complex due to multiple layers of price movements. Traders must distinguish clearly between swing structure and internal structure. Swing structure refers to the broader, significant movements in price that establish overall market direction, while internal structure includes the smaller, minor price fluctuations or retracements occurring within these larger swings. Recognizing the difference between these two types of structure is crucial because it prevents confusion and ensures the bias aligned with the actual trend, rather than getting caught in short-term noise. To accurately identify these different types of structure, traders should clearly understand the concepts of swing highs and swing lows, as well as internal highs and internal lows. A swing high represents a clear peak in price, identified as a high followed by a significant pullback. Conversely, a swing low represents a distinct trough, the lowest point in price that precedes a meaningful upward move. In contrast, internal highs and lows represent minor peaks and troughs within these larger swings, often occurring during brief retracements. Clearly distinguishing between these swing and internal points helps traders correctly map market structure, enhancing precision in their analysis and greatly increasing trading success. An important concept to enhance your market structure analysis is distinguishing between strong and weak highs and lows. This concept revolves around clearly identifying which structural points effectively drive the market forward and which ones fail to do so. Specifically, strong highs or lows are swing points that successfully accomplish their primary purpose in the trend. Strong highs push the price below previous swing, lows to form new lower lows in a bearish market, while strong lows successfully push price above previous swing highs, forming new higher highs in a bullish market. Because these strong points manage to establish fresh extremes, they signify continued strength and momentum, often serving as important structural boundaries. Conversely, weak highs or lows represent swing points that fail in their primary purpose. They do not succeed in creating new structural extremes. A weak high, for example, fails to push price below the prior swing low, indicating a lack of bearish momentum. Likewise, a weak low fails to push the price above the prior swing high, signaling weak bullish strength. Because these points have clearly failed their intended role in maintaining the trend, traders can confidently identify them as vulnerable targets for future price action. Enough of the boring theory, let's dive straight into some practical chart analysis. Obviously, the market structure shown here is bearish, so let's begin noting our points from the upper left. We can clearly identify the starting area as a major swing high, establishing a strong high that successfully pushes price lower, forming a weak low. Moving forward, the price continues its downward momentum, consistently breaking through multiple swing lows, each confirming their status as weak lows. Eventually, the price reaches a point where it attempts an internal bullish correction. However, it ultimately fails to break the previous major swing high or strong high, reinforcing the bearish trend. Bearish pressure resumes, and price aggressively breaks through the most recent weak low, forming yet another significant strong high. At this moment, we can confidently mark this latest point as our current strong high, with the recent low acting as the current weak low, providing clear targets and structure for future trading decisions. To sharpen your analysis further, traders must clearly grasp the concepts of break of structure and change of character. At their core, both concepts help traders identify important shifts in price behavior. However, they serve distinctly different purposes within market analysis. A break of structure occurs when price surpasses a significant swing high or swing low, clearly indicating the continuation or confirmation of the existing market trend. It serves as strong evidence of sustained momentum, validating that the prevailing trend remains intact and likely to extend further. In contrast, a change of character refers to an earlier, more subtle indication of a potential shift in market momentum or direction. Unlike the more definitive break of structure, which involves major swing points, a change of character takes place when price breaks internal or minor structural points within a swing, providing traders with the earliest signal that momentum might be weakening or reversing, while a break of structure confirms continued trend direction by breaking significant structural levels. A change of character instead hints at a possible upcoming trend reversal or deeper pullback, acting as an early warning mechanism. Lastly, effectively mapping market structure requires adopting a systematic and consistent approach. Traders commonly utilize a method that involves waiting for candle closures beyond major swing points. This approach ensures clear confirmation of structural breaks and trend continuations. By relying on candle closures rather than just wicks, traders adopt a more conservative and reliable strategy, significantly reducing false signals that can occur with less stringent methods. This confirmed, closure-based method allows traders to confidently determine when major swing highs or lows have truly been broken, ensuring greater precision, reliability, and consistency in their market analysis. Let's apply the theory into practice. Starting from the upper left, price breaks structure to the downside, forming a new weak low as sellers step in with strong momentum. Shortly after, price continues its bearish move by breaking through another low, further confirming the downtrend. Interestingly, price begins to show signs of internal bullish structure. We see higher highs and higher lows forming on the smaller scale. However, price only manages to push through the previous strong high with a wicks, not a full candle close. This wick break suggests liquidity grabbing rather than a confirmed shift in structure. Eventually, we get a clear change of character where internal bullish structure is invalidated. Price fails to continue higher and instead plummets, breaking through a swing low decisively. This move reinforces the bearish narrative and invalidates the earlier bullish signals. At the moment, price continues to show wick breaks of structure rather than clean candle closures. Because of this, we identify the current low as a weak low, vulnerable to being broken again unless a strong shift occurs with proper candle close confirmation. Accurately identifying trend changes is another essential skill traders must develop. Markets inevitably shift from bullish to bearish trends and vice versa, and recognizing these reversals early provides powerful trading opportunities. Specifically, a bearish market transitions to bullish once price clearly breaks above two major swing highs, indicating a significant shift in market momentum from sellers to buyers. Conversely, a bullish trend transitions to bearish when price decisively breaks below two major swing lows, signaling a strong shift from buyer dominance to seller control. Mastering the identification of these structural changes empowers traders to confidently anticipate market reversals, enabling them to enter trades earlier and align themselves effectively with emerging trends. Let's apply everything we've just learned and walk through this chart step by step. Starting from the upper left, price breaks structure to the downside, giving us our first key reference points. Here, we can mark the major swing high as a strong high and the new low as a weak low, since it failed to hold as support. Moving forward, price continues to push lower, breaking through multiple swing lows, each acting as weak lows, until we reach a point where bearish momentum begins to slow down. Then, we see an early change of character to the upside. Price begins to shift direction internally, hinting at a potential reversal as internal bullish structure begins to form. Interestingly, price starts showing internal bearish structure again, creating some confusion. However, it manages to break below a strong low, but only with a wick, not a full candle close. This suggests a liquidity grab rather than true bearish continuation. Eventually, price makes a decisive break of structure to the downside, this time with a full candle close, seemingly confirming bearish intent. But right after that, price rockets upward and breaks through a major swing high, flipping the narrative entirely. At the moment, price has completed a full trend reversal from bearish to bullish, as it has broken through two major swing highs, confirming the shift in direction. This transition from lower highs and lower lows to higher highs and higher lows marks the establishment of a new bullish market structure. That wraps up today's video about market structure analysis. Be sure to check out other videos in our Smart Money Scalping series. If you found this video helpful, Make sure to like, subscribe, and turn on notifications so you never miss out on our latest trading strategies and insights. Thanks for watching, and I'll see you in the next episode.